So in today's environment of commercial real estate, raising equity is like incredibly difficult. It's damn near impossible. So a lot of times common equity right now, they're just being super conservative, super selective, and it's very hard to raise capital. And that's both on the institutional side and on the retail side. So no matter who you're raising equity from, it's very difficult, very challenging time. A lot of LPs, a lot of passive investors got burned on previous deals in the past few years, so they're just being very, very conservative and very selective. So only the best deals from the best sponsors are getting the equity right now. At the same time, debt is also very much constrained. Since they raise interest rates, a lot of the loans that you're getting, you're not getting the best LTV or you're not getting high LTV. And because a lot of these loans are being debt service constrained. So we have higher interest rates, you have a higher mortgage. So to cover the debt service, you need more cash flow. So for that reason, a lot of proceeds are minimal in terms of like your loan. So a lot of times you're getting LTVs maybe around 55%. 60%, but you're not getting that standard kind of 75, 80% that people used to get. You're not getting that anymore. So what does that mean? Now we're in an environment where you have to raise more equity to fund your deal. At the same time, equity is a lot harder to fund. So it's very tough to get a deal done. Transaction volume is falling off a cliff, and financing and capital is a big part of that. And how are people actually getting deals done? How are people finding deals? If you're able to find a good deal, how are you able to finance it? So in comes pref equity. We're seeing a lot more deals now use pref equity in the capital stack to be able to make the deal pencil, to be able to actually fund the deal and fill up the capital stack. But what is pref equity? So that's what this video is going to be about. We'll talk about what pref equity is, how does it differ from common equity, and how you could potentially leverage it to make a deal work. So my name is Sita Dambuya. I'm a capital markets advisor. So I help sponsors, developers, operators source capital, typically institutional capital, to fund their projects and be able to get their deals going. So stay tuned. I'm going to break down what pref equity is and how it may be useful for you. All right, so before I get into this, I want to do a quick recap of the capital stack overall. So the capital stack, of course, is how you layer your financing. So on the bottom of the stack, which is going to be the least risky and also have the least upside, is going to be your debt, senior debt. So it's going to be your first mortgage. If you ever foreclose, this is the loan that gets paid off first. So that's senior debt, typically going to be around in these days, like maybe 55% to maybe 70% of the total cost of the project. Then the layer above that is going to be mezzanine financing. So this is also debt. It's like a subordinate debt. So it's going to sit above senior debt. And senior debt, as you can tell by the name, is senior to mezzanine debt. Meaning, in the case of a foreclosure, your senior debt is going to get paid first, then your mezzanine debt. Mezzanine debt is going to be more expensive than senior debt is. And it's also going to be more risky. Next layer up is going to be your preferred equity. So now we're getting into equity. So as I mentioned in the previous video, debt is what you owe, equity is what you own. So that's the difference between debt and equity at a high level. But now preferred equity is going to differ from the last layer of the capital stack, which is common equity. And preferred equity is going to be senior to common equity. So preferred equity is going to get paid out before common equity. So common equity is going to be at the top of the capital stack. It's going to be the highest risk, but also the highest return, highest profit if the deal does well. So that's how you layer everything in. Okay, so what is common equity? Let's review that real quick. So common equity represents true ownership of the deal. It's going to be split into two parts, GP equity and LP equity. So GP equity, this is going to be your general partners. These are the actual operators of the deal, the developer, the people who are actually putting the deal together, sourcing the land or sourcing the asset, the building. They're going to be the ones that's running the show, doing the whole project. They take ownership, and they're the ones that are going to be held liable in the case of like any type of lawsuit or anything like that. Your LP, your limited partnership, your limited partners are going to be your passive investors. They're putting capital into the deal. Typically, they're not going to have control. They're not going to be the one that's making decisions. And a lot of times they won't have liability if something goes left because they're not the ones that actually are making the decisions. Though it is important to note that if you have like an institutional LP investor funding the bulk of the equity, a lot of times they may want some kind of control or put in a clause that allows them to take control if the operator, the GP, is not doing a good job running the asset. So common equity, as I mentioned, sits at the top of the capital stack. It has the highest level of risk. So if the value drops on the property, you foreclose, you're not able to sell, and you have to sell at a loss, essentially, your common equity is going to be hit the hardest. Everybody else gets paid first before common equity. At the same time, if the deal is a home run and it does very well, common equity is able to benefit from the profit and the upside more than anybody else. Pretty much common equity and sometimes pref equity are the only ones that actually get the benefit from the upside. Your debt has a fixed return. All right, so what is pref equity, preferred equity? So preferred equity, as I mentioned before, sits between your debt and your common equity. And it actually is kind of a hybrid. It is run or operates kind of like debt in some ways, kind of like equity in some ways. So in the ways that it's like debt, the first one, as I mentioned, is that it gets paid before common equity. So it's the first way that it behaves like debt because it's senior to common equity. The second way is that it is has a fixed return typically, maybe 10%, 12%. It's higher in today's market, but there's kind of a fixed equity or fixed return associated with preferred equity, unlike common equity, which is just based on the deal's performance. The return rate for pref equity a lot of times is going to be split into kind of two parts. One is going to be paid current, almost like a mortgage, and then the other part is going to be accrued. So it may be like a 12% total return where 9% is paid current. So you pay a 9% return on that every month. And then the other 3% is accrued, meaning it's going to accrue, you're kind of going to let it build up, and then you're going to pay at some capital event, whether it's like a refinance or exit, where that additional 3% is paid elsewhere. Now, pref equity is a lot more flexible than typical debt. So you're going to be able to say the property is in cash flow or something like that, or you're not getting enough cash flow. Pref equity, you may be able to structure it to where you don't pay into the back end, or you pay at exit or refi, as opposed to like debt. You got a set payment, and if you don't pay that, they're going to foreclose. Pref equity is a little different, it's a little more flexible. And then the last way that pref equity is like debt is that you have some protections as a preferred equity investor. So you can't necessarily foreclose, but you do have some clauses that allow you to take over operation if the asset is performing or you're not getting paid out. Okay, so how does pref equity behave like equity? So for one, pref equity also represents ownership in the deal as opposed to debt, which doesn't represent ownership. Debt represents an obligation to pay a loan, but pref equity actually represents a level of ownership in the asset. Two, there's no amortization or maturity like with a typical loan. So typical loan is going to have like a term, like a 3-year term, 5-year term, 7, 10-year term. But there's a set term, maybe some extensions, but there's a set term with a deadline of when that loan comes due. Pref equity doesn't have that. Of course, pref equity investors, just like common equity investors, are going to have a timeline that they're targeting of when they want to get their full money back plus the return on their money, so they can pay it out if they have other investors or they themselves are the investors. They have a timeline, but it's not a hard deadline as with debt. All right, next way is that pref equity can't force a foreclosure the same way that debt can. So same way like somebody who services your debt can foreclose if you don't pay the debt, pref equity doesn't have that right. As I mentioned, if they're not getting paid, there are some clauses that allow them to take over ownership, which then they could sell the asset, but they can't just force a typical or traditional foreclosure the way that debt can. All right, another way is that pref equity also can share in the tax benefits of ownership. So we know that there are tax benefits. You can write off like depreciation, you write off expenses or losses. There's certain benefits and tax benefits to owning real estate. If you're like a lender and you provide a mortgage to somebody, you do not get the benefit from those tax benefits because you don't own the asset. But as I mentioned, pref equity represents ownership of the asset, so they can benefit from the tax benefits that are associated with owning real estate. Now, not all pref equity investors are going to require that the tax benefits flow to them, but that is something that they have access to as a pref equity investor. Pref equity also can participate in the upside. That's going to happen when you have a equity kicker. So equity kicker is going to be like a clause that allows the pref equity investor to participate in the upside and the profit of an investment if it does very well, typically once it surpasses some kind of hurdle. Now that's going to be structured in before closing, so you kind of know when that hurdle is going to be hit. But they can participate in the upside beyond just that fixed rate of return. All right, lastly, pref equity is going to be more expensive than debt. So, of course, debt is going to charge an interest rate. Pref equity is going to charge a higher rate of return, typically not as high as what LP equity is going to expect or common equity is going to expect, but it's going to be much higher than what debt is going to charge. Now, in today's market, pref equity is even more expensive because one has become more prevalent, is more in demand, and two, we're just in an environment where any type of equity is just a lot more conservative. A lot of equity investors are more conservative, so they're charging a higher rate because there's a perceived higher risk of any type of equity. Okay, so why should somebody use, or why would you, as a sponsor, put pref equity into your capital stack? So for one, it really helps to increase the leverage you have to reduce the amount of common equity you need to raise. So as I mentioned before, a lot of times the loans that you're getting in this environment, you're not going to have very high leverage. So that leaves a huge gap of equity you need to raise. Some people can raise that equity. Some people, the returns aren't as good when you raise that much equity. Either way, it may be beneficial to add a layer in of preferred equity that can get you to a 70% LTV as opposed to 55% that you're getting with debt. So that reduces the amount of common equity you need to raise, which is going to potentially make the returns better on the common equity than if you had to just raise all of the common equity up to like 45% of the capital stack. Another reason is that it's going to be less expensive than common equity, and it's also not going to dilute the sponsor control the same way that common equity is. So of course your pref equity is going to have a rate of return, and it's going to be fixed with some being accrued, but it's going to be generally be lower than what a common equity investor is going to look for in terms of return. So it's going to be cheaper, and then you also don't have the same control stipulations that can accompany a common equity investment. Also, that accrual feature is going to help with, value add or lease up periods where you're maybe not cash flowing a lot. So allowing some of that rate to accrue that you pay later at a capital event, as opposed to having to pay monthly, it can help when your cash flow is constrained in certain periods where you're trying to get stabilization. It's also a lot more flexible than, mezz debt is, senior debt, and even common equity is going to be very flexible. So you can kind of do a lot of different things with pref equity. As I mentioned before, you can maybe not pay for the first year if you're doing like a value add, you're trying to stabilize. You may be able to capitalize the first year's payments, meaning you pay them at closing as opposed to having to pay them monthly. It also, allows for the accrual, so the whole rate isn't paid monthly. You instead can pay it later at refi or exit. So the flexibility can make it a little more easier to deal with, and you can really make it work for your deal if you're dealing with a pref equity investor that is willing to work with you on some of the terms. And lastly, and most importantly, pref equity is going to be a lot easier to raise than common equity. And that's because it's less risky. Because it comes before common equity and the capital stack is going to get paid before the common equity. So essentially, that common equity, which sits at the top of the capital stack, which is the last to get paid out in any type of event if things go left, because there's a cushion there of common equity, your pref equity is going to feel a lot better. They're taking on less risk by investing in the asset, and they're more likely to get paid out because they know that common equity is the first thing that's not going to get paid out. It's the last on the list, so you're going to get paid before that. So there's less risk associated with pref equity. All right, now what are the things that you got to look out for if you're putting pref equity into a deal? One, as I mentioned, is going to be if the leverage is too high. So if you already have decent leverage on your debt, then you put another pref equity layer into that capital stack, and the combined leverage from both of those is high, that can add a lot of risk to your deal. One is going to make the pref equity more expensive because, as I mentioned, once you get higher up there, there's less of a cushion of common equity. So your pref equity investors are going to charge you more. So now there's a risk of the cost of the pref equity, and then there's more risk in just being over leveraged. So the pref equity acts as a double-edged sword. So it can help you if the deal does very well because you're able to have that pref equity is going to make the returns on the common equity, the GP and the LP equity The return is going to look much better if the deal performs well. But if the deal doesn't perform, it's going to hurt you because now you have an additional layer of capital where you're responsible for making those payments. It's probably a monthly payment that you got to pay. And then you also had that accrued payment that's going to eat into your profits at refi or sell. So it can hurt you or it can help you, but it is a tool one way or the other. Another thing to look out for is that raising pref equity can actually make it more difficult to raise common equity. So if you need to raise common equity, pref equity can pose a challenge because now the common equity knows that there's another layer of capital that needs to get paid out before them. So it's also like just having additional leverage. So if you're like your senior loan is too high, if you have senior loan and mezz debt, whatever it is, common equity doesn't like leverage to be too high because it limits their ability to recoup their investment. It increases the risk to them because they're going to get paid after all of these different layers. So just keep that in mind that it can make it a challenge to raise common equity. Sometimes common equity investors may have a clause or just a rule of thumb where they don't invest in deals that have a pref equity layer. So just keep that in mind. Also, pref equity typically is going to work best or really only work when there is a strong value add component, like of course a construction ground up project or a value add project. So there needs to be some way to be able to increase value so that you can refi and pay out your pref equity investor. Otherwise, that pref equity investor is going to have to stick with you throughout the life of the project until you exit. So we want to make sure there's a strong value add component in most cases for a pref equity investment to work out. All right, so that's my overview of pref equity. Hopefully, you got some value out of that. Hopefully, you understand how it differs from common equity, and then also how you may be able to leverage it into your deal. Pref equity is becoming very, very common in deals nowadays in this environment. So if it's a tool that can help you get a deal done, by all means, go ahead and use it. Please let me know in the comments what you want to see. If there's any other topics that you want to cover, feel free to reach out. Hit me up on LinkedIn. And if you got some value out of this video, please go ahead and like, comment, subscribe, share it with somebody else. And I'll see you in the next video.